And we're live.
Hey everybody, it's Ethan Zerka here, not to be confused with our guest, but I've got
Ethan
my
Vera.
business partner over here, Saqib. Saqib, please introduce our guest today.
Yes, today we have Ethan Vera, and Ethan Vera is from Luxor, which is North America's largest pool, and they support many different coins, including Bitcoin, on their pool. Ethan, please introduce yourself.
Yeah, thanks for having me on, guys. Like Sakib said, I run Luxor. We founded it about 3 years ago today. Really is like an altcoin pool. We saw a lot of those altcoin communities and thought they were underserved from a pool perspective. So wanted to get them a better product offering. And then, yeah, continue to build out, spend about 95% of my working hours now in mining. So, love talking pretty much anything in the entire stack and excited to be on here with you guys.
Before you tell us what you're into today, tell us how you got here. What is the path that brought you to where you are? So you said you've been a part of Luxor for 3 years. So you probably are kind of an OG. You go way back. So tell us how that happened.
I guess 3 years is now getting OG status. We're seeing like a new wave of institutional miners come in. So 3 years is actually a long time for some of them. Really, I was in college at the time, doing my fourth year, finishing up, and my friend and now co-founder Eddie kind of dragged me into Bitcoin and mining. He was like, "Hey, you gotta check this out. This is like an up and coming technology." And really, my fascination with Bitcoin never broke away from mining. The mining aspect was the coolest part for me. That instead of having a centrally planned Fed that determines the supply of money, anyone with a machine, electricity, and internet can take part in that minting process. And that was like fascinating to us. And so we wanted to build products around it. And as like college kids with no capital funding, like what can you build? And we thought, hey, let's build some software products. Eddie and Nick are both software engineers. So that's probably where we can play best. And yeah, so we started building software products for the mining space.
That's really awesome. That's really awesome.
I mean, when I first got into mining, I was doing GPU mining, and basically, I see that you went to the software route instead of directly going into the mining route.
Tell us, did you have any stumbles or road bumps along the way?
Well, funny enough, the stumble was actually when we tried to play in the infrastructure space. We originally had the company vision of software. But we had this idea, and maybe it sounds like better than it actually is in practice, of vertically integrating. Sometimes vertically integrating always sounds great, I think, but at times maybe it's like a ball and a weight on your foot when you're trying to swim. And so we actually invested in a mining farm in Kansas City called Minery Tech. We were a minority shareholder, but it ended up going pretty poorly. Fast forward 12 months later, it went bankrupt, and it helped us realize a couple of things. One, we're not infrastructure guys, so we have a lot of respect for guys that do it. It's really tough work. And then two, the mining industry is just so volatile. The value of hash rate switches around so fast. We're seeing it now, with rev per terahash down below 8 cents per terahash per day. And so the inability for miners to like hedge out their operations or transfer some of that risk to investors can really lead to volatile business models. And how many bankruptcies have we seen this year? 10 plus. So I think that's going to continue as long as those derivatives aren't here to help miners. And so that was some takeaways that we had, and it was a stumble we had, but also a great learning experience.
What do you feel is just mission critical to success? Like, what do you feel is maybe like the biggest mistake that miners make these days?
Biggest mistake. I think there's probably a lot.
Right.
I think probably relating like to your business, like the broker side of the business, buying machines at the right price is increasingly vital to the success of an operation. People that have good ASIC procurement will have an advantage, a leg up for the long run. And you're kind of seeing like some types of cartels forming now on at least the latest gen machines, where they're booking up 3-4 month supplies of MicroBT or Bitmain in the future. And mid and small size miners can barely get their hands on 100, 200 rigs. So those players are going to have like a huge advantage moving forward. I think if there are small players that want to play profitably, they have to know how to navigate the secondary markets well, working with guys like yourselves and getting that dollars per terahash down on their capex front.
Yeah, absolutely. That was an awesome answer.
So I had a question, Ethan. What percentage of hash rate would you say that your pool is a part of for Bitcoin, let's say?
Yeah, Bitcoin, we're still relatively small because we've historically focused on altcoins. So our largest pools right now are like Dash. We have about 25, 30% of the network hash rate.
Oh, wow.
Horizon about 40, Zcash 5 to 10, Sia around 30. So relatively strong into altcoins. Bitcoin, we're just scaling up now, so around 120 petahash as of this morning. But that's definitely going to be a focus moving forward.
Excellent. Why is it becoming a focus? Do you just not? Let me ask you this: do you see that the altcoin market is maybe going to have some turmoil in the future?
It's hard to say, right? Like everyone's kind of lost interest in a lot of these like OG coins, like a coin, for example, like Dash or Zcash. You know, DeFi is a little bit more shiny now. Like, why would you buy, Zcash when you could buy Uni or Wi-Fi? So I think there is going to be some momentum lost out of kind of traditional proof of work altcoin markets. But in the next retail boom, I think there are a lot of people that will eye things like Litecoin, Dash, and Zcash, and will get support behind it. So it's hard to say for sure. I wouldn't say optimistic, but definitely not pessimistic either.
So I want to know your thoughts on Wi-Fi. For those of you who haven't heard of Wi-Fi, Wi-Fi is a coin that like literally started out around $34, I believe. Yeah. And in less than a year, it has just skyrocketed from $30 to 40,000, I think was the top of where it reached. So what are your thoughts on that? How does that happen?
It happens because there's just everyone wants to buy on the exchange and no one wanted to give it up. Wi-Fi had a really good thesis of like a very limited supply of coin and a hard cap. I forgot what is it in the tens of thousands. It's very small. And so I think there's like some element of scarcity there in a day when everyone has like millions and potentially billions of coins outstanding. But Wi-Fi principle itself of like aggregating yields is definitely interesting, especially in today's like era of yield farming. And so it seems like the perfect play for DeFi. I probably only spend a fraction of my time looking at DeFi, mostly because mining is a full-time job.
Oh yeah, but absolutely.
It is something we actively look at. Like, how can we integrate those types of yields for our miners to earn extra return on their balance sheet? Because treasury management for miners is a huge part of their business. We're seeing that now with partnerships between like Poolin and BlockFi. Like, how do you mine reward and then earn extra reward, staking it or yield farming with it or loaning it out on something like BlockFi. So it's something that we're looking at for sure and monitoring closely.
Can you explain a little bit more in depth what yield farming is and how it is different than traditional farming?
Yeah, I don't know if I'm best placed to be the DeFi expert on the panel here. You probably know more than me, Ethan. My understanding of it really is you're just providing liquidity for these underlying protocols, and you're getting rewarded as a result. I don't know how sustainable some of these things are. So some of these projects are giving like 6,000% APYs. Probably a mix of both that it's a very risky investment, but also that there's greater fools that will demand that liquidity. And so how long are there going to be greater fools for? I'm not sure. I think that eventually like the end game of this is that APYs will have to come down somewhat similar to centralized finance. DeFi is nothing like special that you can yield like 6,000% APY for the rest of our lifetime. So I think it's a matter of time before it starts coming down, and then DeFi will become a little bit less shiny.
Yeah, I think you're right, because whenever you have something that has inflation, massive inflation like this, there's got to be something on the other side that balances it out, and the price eventually catches up, to the inflation. So it's just a matter of time, I think. And as you said, projects that are actually decentralized, more decentralized, and are mined using, with electricity, something like Dash or Litecoin, I think they will be more appreciated in the future once this DeFi wave is gone.
Yeah, that's very interesting stuff. What do you have a personal favorite? Do you like what are you mining right now personally?
Mining personally, I have a few SHA-256 rigs and a couple of Equihash. I think Equihash has always had like a soft spot in our heart. Zcash, Horizon were some of our first pools, and then we built Komodo and Pirate Chain after. And the reason we love it so much is because there's really good profit switching opportunities between the chains. So Equihash is the underlying algorithm, which you can mine on like a Z11 and then a Silicon A9 and now a Bitmain Z15. You can mine Zcash is the predominant one, obviously, like 70% of the market cap of those coins. Horizon's probably 20, and the rest of the 10 is filled by other coins. But there's really good uplift opportunity there if you mine between chains. So our profit switching algorithm has been doing like 5-6% uplift over Zcash, which is like pretty insane for a mining operation, especially one that's operating at the margin. So that's been like very fun for us to develop. We've kind of like geeked out over it, and it's definitely like our personal favorite.
Yeah, it's sort of like dual mining for GPUs. You know, you're getting an added benefit with whatever you're mining.
Yeah, we switch between chains, so at any given point, your rig is only working on a single chain. But we switch every like 3-4 minutes. We update, okay, which of these coins is the most profitable to mine on a Bitcoin basis, and let's switch over to that one, or potentially switch over. If you're already mining it, then we just stay.
And you know, you mentioned previously you want to get more into the SHA-256 mining algorithm. Can you tell us a little bit more about that?
Yeah, it's actually not that intuitive, but starting with a Bitcoin pool is actually pretty tough. Mostly because the mistakes you'll make if you build your pool from ground up and don't leverage existing code is like you're going to make mistakes along the way. We've made plenty. And fortunately, they don't cost that much when you're in altcoins. But if you're, say, orphaning a Bitcoin block, like you're burning 100K, right? Like it's an expensive mistake. And then second is like the liquidity required. So in today's world, almost every mining pool operates on a pay per share basis. So paying out on the expected value, and you're paying miners up out front. And that means that as a pool operator, you got to absorb that variant risk. And if you don't have a large liquidity pool, you could actually bankrupt yourself. And so for something like Bitcoin, you actually need quite a bit of liquidity to cover that upfront payment. So, you know, for us starting the company out of college, like we didn't have that. So by building up these altcoin pools, we built up a war chest, but we also built up a stabilizer where if we have a bad month mining Bitcoin, maybe we had a good month mining Dash, they kind of balance each other out.
They equalize out. That's very smart. Diversify.
Yeah,
exactly.
I noticed that you have a Zen Horizon, and now I started mining Zen when it was, you know, back like I think less than $3. And you know, I was on many different pools. I think I used your pool at one point as well. But yeah, how long have you had Zen on your pool?
Since 2018. I would say very few miners stick with us for just Horizon now. Those miners will come over to Switch because we do about like 10% uplift over Zen right now through our profit switching algorithm. So we've slowly tried to migrate people over. There are some people that want to mine like a native token, and that would mostly be because they want to support the project, or they're really bullish on the token and they want to get paid out in it. And so those would kind of be the exceptions. But everyone else is more like profit driven, like give me Bitcoin, give me more uplift type thing.
Right.
So it's no secret that you have competitors in the market, and you know, sometimes these competitors can do shady things to you guys to prevent. And I'm not going to name any names, but can you give us an update on, you know, what your security situation is? Have you had anything interesting happen security wise?
Yeah, I mean, you're right. Like the mining pool game is very competitive. It's very cutthroat, and in some ways it's very zero sum. So if one pool loses, it's at the benefit of every other pool. There's quite a few attacks you can do on mining pools. Obviously the standard ones like DDoS, but one of the more like creative attacks you can do is what's called like a block withholding attack, where basically another mining pool will redirect their hash rate, proxy their hash rate towards your pool.
Mm-hmm.
You'll be paying them for their hash rate because you don't know who they are. You just know that they're giving you valid work.
Yeah.
But they have a way to check to see if the share that they're providing you is actually a valid block or not. And if it's a valid block, they'll discard it. So what they're doing is basically sending you junk work.
Yeah,
And
they're sending you useless stuff, noise.
exactly. Yeah, it's like from a technical perspective, it's a hash value that results lower than the share target, but not lower than the network target. So it's still counted as a valid share by the pool, but they know it's not going to be counted as a valid share or a valid block by the
That's
network.
so shady. That is so underhanded.
And if they send enough of those, they can definitely do some damage.
Yeah.
Oh
So
yeah.
a paper share pool like us, they can bankrupt us. I suspect it's happened to Slush Pool in the past too. And for a score-based system or PPLNS like Slush, basically all their customers will be like mad at them and want to leave because they're not mining as many blocks as they should have. So it hurts both types of payment method pools. And yeah, it sucks to deal with.
Yeah, and I've had this happen before where I've mined empty blocks on many different pools, and I didn't notice it until maybe a day later. So you're mining for nothing for that point, for that time.
Yeah, that's just like I said, just wasted noise. We're going to take a quick break here to take a look at our sponsor today. Sakib, can you pull it up?
Yes, I'm going to pull up our website here, Crypto Mining Tools. And on Crypto Mining Tools here, we have our calculator app, our comparison app, and our shop, for example. We have the best-selling miners here on the market. And at this moment, you're also able to go into our directory. And from our directory, you can select what type of hosting you want. You select what miners you have. And it's a really easy process to basically request a quote from any facility worldwide.
Yeah, that's absolutely fascinating. So Crypto Mining Tools is a place where you can educate yourself on what the most profitable miners are. You can then compare that miner against the miners in the market to make sure that, just like Ethan, you mentioned before, that it's all about getting the maximum yield for your capital expense. And then once you've decided, what miner is a good fit for you, you can go to the shop and you can look around at our inventory and you can buy that miner. And then you can find the best hosting, because that's another part to it as well, is it's not just simply getting the maximum yield on your purchase, but also making sure that that miner is run in a facility that has, electricity costs and, maintenance that will keep your miner online and keep it hashing, so you can get the most out of it.
Yeah, and we're always adding, new features to our calculator. We're adding profitability features as well. We have we're developing a backend for brokers as well. So we're in constant development mode.
Yeah. Every day, changes and improvements are being made to the website. So visit often, and we're hoping to bring online many different algorithms here soon, so you can calculate not just for Bitcoin but many other coins. And we also want to bring online GPU products as well. So yeah. So back to you, Ethan. What can be done? Do you guys do any special or precautionary measures to stop this underhanded hash rate that can be sent to your pool?
There is no like foolproof way to stop it, but what you can do is you can monitor mining luck per rig and per user account and see like, hey, this miner like has been paid out 6 times as much as they should have been. They still haven't found a block. And unfortunately, what you do at that point is you just freeze their account and say, hey, can you contact us? Let's like set up a quick call. I just want to like confirm who you are. It's only happened twice.
The number you've reached is
exactly right. Like if they're an honest actor, they'll take a call. It's only happened twice, and both times like it ended up being like somebody who wasn't attacking our pool, and we just unfroze their account balance and they continued to mine, and the mining luck ended up just being bad for that period. I think like really that taking that precaution is all you can do at this point.
Okay, so you have some sort of system that evaluates the luck across all the workers, and if you find some workers that are having some very unusual low luck, that's when you will contact them and say, hey, we've noticed some, unusual activity in your account. Please, contact us and let's discuss what's going on.
Exactly, yeah. So mining luck follows an Erlang distribution. So based on a percentage like luck statistic, you can see like what's an over a specific like block amount, you can see like what's the probability of this happening. Let me just throw rough numbers out there, but say you have a luck statistic of like 6 over 10 block period. You can determine, hey, that's like there's a 98% chance that shouldn't have happened. If we ran that back 100 times, 98 out of 100 it shouldn't have happened. And then you can start to set some like intervals of like, okay, at 99.9, let's freeze their account because that's like extremely unlucky. Maybe there is a slight percent chance it was just pure mining luck, but let's at least check.
I know that casinos do a very similar thing. They will, measure the input and the outputs of their table, and to a very, very fine degree, they can determine if any kind of cheating is happening, because they know to a very exact number that for X amount in, X amount should be paid out, and if any more than that gets paid out, then they, start looking into people cheating and whatnot.
Yeah, mining like a paper share mining pool is the exact same as a blackjack table, right? Like as the pool operator and the dealer, your odds are set in the long run. You're going to make that, say, 2% spread. Short run, who knows what happens? Sometimes you may be up a lot, sometimes you may be down a lot. But yeah, like you said, like at a certain point in time, the distribution will fall so that like exactly like, okay, this is too low or too high for the time horizon we're looking at.
Right. You'll have a standard deviation, basically.
Exactly.
So Ethan, I wanted to ask you, what sets Luxor apart from other pools? Please talk about that.
Yeah, I think I was mentioning earlier, the pool space is competitive. It definitely is. There's a lot of great pool operators out there. I think everyone really is rushing to fill this like ecosystem play. People are realizing that a standalone mining pool is kind of outdated. It's no longer going to be the future of mining, and so there are companies like Poolin that are like rushing to add financial services, and like Slush Pool is doing the firmware integration, so trying to do like a broader ecosystem play. At Luxor, we've been focused on a couple things. One is profit switching. So I think the days of like single chain, narrow focus mining are almost over. Miners are majority profit driven. So if there's ways to squeeze out extra profit, you kind of need to do it as a pool operator. So like now we kind of think of ourselves as more of like a best price execution where we're accessing deeper liquidity than just the Bitcoin emission rate. You can access things like the Bitcoin Cash, BSV, Digibyte, nice hash, maybe like sell it onto a contract, sell it to another pool, whatever. Like you need to have like a whole order book of like different liquidity partners, whether that's networks or other companies. And if you can access all of them, you can get a better like profit return for the hash rate. And ultimately what you can do then is then pay your miners out more for their hash rate. So that's obviously an area we're very focused on. And then the second would be building hash rate based derivatives. It's still a bit far out, but we really think that the market needs like better instruments to hedge for miners. So we want to play a role in crafting some of those derivatives and getting them to market.
Can you give us a little bit more in-depth explanation about that? I find that fascinating. So explain what it is and how you guys intend to bring it to life.
Yeah, this concept really came from looking at traditional industries. And before Luxor, I was working at Goldman Sachs as an investment banker, and a lot of our clients, right, are either commodity producers, natural resources, any type of manufacturer, and an integral part of their business is hedging out some of their forward revenue. So they're producing an underlying commodity. Let's go to a simple example like oil. They don't want to take a directional bet on the price of oil in the next 2 years. So they're going to lock in a value per barrel of oil. And they know maybe for 60% of their operations, this is how much we're going to get paid. And so that if oil drops to $20 a barrel or even negative, they're not going to go bust. They still have the ability to sell it at their locked-in price of say $60. So it's taking these traditional concepts and bringing it to a new space. Mining is still the Wild West, but it's quickly transforming to a more institutionalized industry. So it's like, how can we bring those traditional concepts to mining? What these ASICs really produce is computational power. You know, a SHA-256 rig produces SHA-256 computational power. Z15 produces equihash. And so we want the ability to hedge on the underlying commodity that the machine produces. And so building derivatives on the value of hash rate itself, I think, is extremely important for a hedge. And so that's really kind of what we're focused on, is like building futures where you can lock in the value of hash rate. And so as like, just to wrap it up here, like let's say hash rate's at 7.5 cents a terahash per day right now. We want to create a product where you can hedge out a year and a half and sell it forward at, let's say, like 7 cents or 6.5 cents. Like maybe you take some haircut on it, but you lock it in for the foreseeable future.
Right.
So can you give me an idea of what this hash rate could be used for? If you're going to treat it as a commodity, is it a commodity that's only going to be able to mine Bitcoin, or is it a commodity that's going to be able to do something else?
I think computational power as a whole, like you can get quite have a good imagination of every aspect of the digital societal touch. For like SHA-256, it's obviously a very narrow focus. Usually 85-90% of it will end up on the Bitcoin network. Some of it will end up on other networks like Bitcoin Cash, BSV, Digibyte, TerraCoin, Peercoin.
Peercoin,
yeah. There's like probably 10 others, right? But those are the main ones for sure. So it's a very interesting dynamic. Like compute power itself is an interesting asset class. It's ephemeral by nature. It's kind of like electricity, where you can't store it. You have to use it or lose it.
Once it's used, it's used. Like
yeah, and you can't hold it, right? Like right away, you need to have
deploy it
basically
instantly.
Yeah, it needs to be. You need to have a Stratum enabled endpoint pre-configured to mine the Bitcoin or other networks. And if you don't have it configured already, it's wasted shares. So it's an interesting asset class as it is. And then you tack on the fact that the end customer is actually like a blockchain instead of like, say, like for oil, maybe like an airline industry. Now you're swapping out the airline industry for a blockchain. It's fascinating.
It is. I know that there's a lot of NiceHash has a marketplace for hash rate. And so I think that's something that you're trying to bring into the industry as a standard. If we can standardize that, I think it'll really help the large operations as well.
Yeah, very interesting things are happening. Where do you see? Let's look further into the future. Where do you see things going? Let's say 5 years from now.
5 years from now, I suspect like at least 50% of hash rate will be exchange traded. Right now, hash rate is traded like over the counter style between miners and mining pools. Like miners will go to a mining pool, negotiate a special fee, directly like have a contract with them and sell them their hash rate. That's OTC. It's a very, I think, immature way to run a commodity industry, and it results in a lot of the ways that miners hate mining pools. Is like they don't know if they're getting paid the right amount. They don't know, like there's no transparency there.
Yeah, there's no market competition or transparency. Yeah.
Like how do miners compare like mining pools? They usually run like 10 like machines on each for like a month. Like that's a really bad way to determine who's more profitable. So I think it's a natural transition that the majority of hash rate will swap over from OTC to exchange traded. And then the benefit of exchange traded is that there's no transparency. You know exactly why you're getting the rate you're getting. You can see the order book. And then two is you open up the buyer universe. There's tens of thousands of sellers of hash rate being miners, and there's only like a handful of buyers, the mining pools. That's a really imbalanced market. And so if you can add more market participants on the buy side, you should start to see the value of hash rate increase.
And do you think that will also increase, just the value of the coins themselves in the market as well?
I don't know if miners have like a huge effect on the value of coins.
Well, I mean, like obviously, if they don't sell what they're mining, then it creates more demand than there is supply, and by logic, that should increase the price, right?
Mhm.
Yeah, I think it's going to be really fascinating to watch. I think there's going to be less and less miners just holding their coins in Bitcoin versus leveraging their balance sheet. Mining's obviously a very tough game now. Margins have come down significantly. So if you don't have good treasury management, you're kind of at a disadvantage. I foresee more and more miners wanting to like earn Bitcoin, obviously sell enough for their OPEX, but then start like loaning it out on things like BlockFi or other services where you can earn like a 7% APY. And then try and get some return that way. So some of those contracts are really interesting because you don't actually have to lock it up for that long. So you can lock it up between CapEx cycles. So like you make a bunch of Bitcoin, you're going to crypto mining tools to buy miners in 4 months. Like for those 4 month period, like earn some return on it, and then maybe you can buy more miners.
Yeah. Well, guys, we're getting to the end of our podcast here. Ethan, how can people reach out to you if they want to get in touch with you?
Yeah, I'm on Twitter, Ethan_Vera.
Yes. And I'm like, who's posting under my name? That's Ethan. That's Ethan Vera. It's not Ethan Zerka. Okay.
It's a team effort, man.
Right.
We bring each other up.
Right.
Yeah, so you can find me on Twitter there. We also just launched a new website called hashrateindex.com, kind of aggregating rig price data, tracking public mining companies and some of their like trading multiples. So yeah, feel free to jump over there. All the data is free, so feel free to use it and give us any feedback if you think there's some cool analysis we can add.
That is really awesome, man. Yeah, that is really helpful. And yeah, thanks for being on our show, Ethan. It was really good to speak with you, and give my best to Nick. Nick was our first on the podcast. So yeah,
Right.
and just like Nick, you were very fascinating. Had a lot of great insight and depth.
Excellent.
Thanks for having me on.
All right.
Thank you, Ethan.
All right.
Bye.
All right. See you guys. All right, everybody.
Bye.